Hi everybody, welcome to 3 Minutes with Mark. I'm Mark Pizzacalla. Great to have you here for the August edition, and I've got my yellow t-shirt on, my FIFA World Cup t-shirt, supporting the Matildas, so hopefully we have a great week. But what I'm talking to you about today is private company loans, and you might say, well, what's so exciting about that? Well, there's a big thing that's been happening with private company loans, and that's the interest rate. And for those of you that aren't aware, for those taxpayers that run businesses or have investments in private companies and they build some level of wealth, they're able to make loans to shareholders and related parties of shareholders of that private company. But when you do, you need to put a loan agreement on Division 7A loan agreement terms. And that basically means that there's got to be a benchmark interest rate that's applied, which is aligned to the bank variable housing loans interest rate. So when that goes up, the benchmark interest rate goes up. And of course, there is now a massive increase in the private company loan interest rate. It's gone from 4.77% last year to 8.27% from 1 July this year. So that's a massive increase, and that's caught a lot of taxpayers by surprise. It really has. So taxpayers at the moment are scrambling, trying to work out, well, what do they do? Do they continue with their loans that they've got from their private companies, or do they have to do something else? Well, the first thing they have to do is they need to continue to meet their minimum loan repayments to their family company. And if they don't, then essentially the missed loan repayments, become unfranked dividends, fully accessible in their hands, and they get no imputation credits as well. So it's a double whammy. There are some solutions which should be considered. Division 7A loans come in two forms. You can have a 7-year Division 7A loan, or you can have a 25-year Division 7A loan. So you might want to try and look at that and see whether you can convert or transition a 7-year loan to a 25-year loan. But of course, in doing that, you need to have a security or a mortgage across the 25-year loan. So that may not be possible for a lot of people. Secondly, you might want to approach the tax office to see what you can do there if you've missed some repayments. They can be lenient, particularly we've seen it in terms of GFC and more recently with COVID. But of course, I wouldn't hold my breath. So what we're really telling people is, look, you need to revisit your funding model, your debt equity position, as a result of the massive increase in that private loan company interest rate. It's really important to revisit your debt equity position and at the same time revisit your tax planning for the balance of this year, and also explore any third-party alternatives. Look, that's all I wanted to discuss today. If you do have private company loans, feel free to give me a call if there's anything you're finding a bit confusing. But otherwise, hopefully the Matildas get up for us. Speak soon.